Okay, good to see you all. Seems to be like an ant house, okay, quite busy, which is very good. We have a diverse set of participants today, starting with students and experts, and of course we also have financial media. Bloomberg is here. Hello, Aaron. Good to see you. I hope for questions. But of course, welcome to the event, and I think it's extremely appropriate, the timing, and also the series themselves, Geopolitics Unscripted. Thanks for SSE Riga to host us today. Today is a busy day. I understand President of Moldova is around, and we have my good colleague Piero Cipollone from ECB to give a speech as well. And I think it ties closely with the same message. Geopolitics is important, but you can't be geopolitically strong if there's no money, okay? So finances do matter. And who else can better tell the story and talk about this than Piero? He has an outstanding career at the Bank of Italy, and of course, being a member of the ECB Governing Council since 23, responsible for the plumbing of the financial infrastructure. About digital euro, retail, also wholesale CBDC, payments, and all the related issues. Before I give floor to Piero, just a couple of comments on geopolitics. And where else than here we feel the importance of the changes in the global economy, in geopolitics. We are part of Europe, and I don't want to agree that we are in the outskirts of Europe. We are part of Europe, but we feel the chill, okay, from the open fridge in the east. So we understand many things and feel it in everyday life. And the key, of course, is that we are strong if Europe is strong. And Europe is strong if it is integrated, if it's aligned, if it works together, if it understands the way forward. And we do have lots of things to deal with, but we know what things need to be done. The world is increasingly fragmented. It is challenging, but we in Europe, and we Europe as such, do have a choice to make. Do we want to be a superpower, or we retreat and become middle powers at best, or lots of small countries that take the decisions of others and choose the least bad? Or we can become a fully fledged economic and political superpower and decide the agenda that is in our interest and drive the decision. And I think we can still do that. And financial markets, of course, are important element for that. In terms of the current setup of the financial markets, unfortunately, we have to say that in its current shape and form, the financial markets in Europe are not up to task. Okay? There are lots of things that we need to deliver and we need to develop. It is single market in financial services, we need scale. There are lots of things that we can deliver to make European case much, much stronger. And of course, payments, digital euro, wholesale CBDC are an integral part of that. The international role of euro overall, of course, is a critical benefit that we can create and build to a much stronger degree that we currently have. And who else can better talk about that than Piero? So Piero, please welcome to the stage. Then we will go to questions and answers, and we have to wrap up by 1:30, the latest. Thank you.
So thank you, Mārtiņš. You couldn't set the stage better than that. So I'm grateful to the Stockholm School of Economics in Riga and to the Latvia Banka for hosting this event, and let me explain how digital euro can ensure Europe's resilience and autonomy in payments in a fragmented world. Latvia's relationship with the euro goes well beyond monetary policy. On adopting the single currencies in 2014, at the height of the euro area crisis, Latvia made a strategic choice. When Prime Minister Valdis Dombrovskis asked his fellow Latvians, if they wanted to belong to the core of Europe, the answer was a resounding yes. This was ultimately a decision about sovereignty. For Latvia, as well as Estonia and Lithuania, joining the euro, like becoming a member of the EU and NATO before, was a way of anchoring its European identity and strengthening its geopolitical position. It reflected a conviction that small countries can reinforce their sovereignty by sharing it freely and willingly with trusted partners. But sovereignty is only as strong as the infrastructure it rests on. And that infrastructure must be resilient, as the Baltic and Europe more broadly learned the hard way in the energy domain, where long-lasting dependence on a single external supplier turned almost overnight into a strategic vulnerability. The Baltics have since diversified their energy supply, clearly illustrating that a country needs to control its infrastructure if it wants to shield itself from decisions made elsewhere. That lesson has since echoed across one area after another of Europe's economy, from supply chain to semiconductor and critical raw materials. Today, I want to apply that wisdom to payments. I will argue that we need to reduce our existing dependencies in payments and avoid creating new ones to ensure our economic resilience and strategic autonomy. But let me be clear. Strengthening Europe's autonomy does not equate to adopting a protectionist practices that would close our markets, reducing competition, and making us weaker in the long run. It means ensuring that we have a sovereign payment infrastructure and solution that Europeans can always rely on and that provide sound foundation for open competition and innovation. Let me specify how dependence on non-European financial infrastructure translates into vulnerabilities. Several mutually reinforcing mechanisms are at work. The first is disconnection. Dependence on a non-European infrastructure leaves users vulnerable to an outright withdrawal of access. As payments are vital to daily life and the economy, the mere threat of disconnecting payment system could give others leverage on Europe. Second, the second mechanism is extraterritorial reach. This is the capacity of one country legal framework to propagate into other countries through globally integrated infrastructure. Individual individuals can be directly and tangibly affected, for example, by being unable to use bank card or conduct routine transactions. Judges at the International Criminal Court recently experienced this firsthand. The third mechanism is the dominant providers the third mechanism is that dominant players ultimately exercise market power. International card scheme can set the terms, the fees, the technical standards, and the dispute resolution procedure applying to hundreds of millions of European transactions every day. By contrast, European merchant and payment service providers are generally rule takers rather than rule makers. The most obvious indication of our dependence on non-European payment system for day-to-day transaction is the exceptionally high level of foreign card penetration. 2/3 of the euro area card transactions are governed by business rules of non-European companies. And 2/3 of the euro area countries, including all 3 Baltic states, depend entirely on international card scheme for in-store payments. At the present, there is no pan-European, Europe-governed digital payment solution that covers the entire euro area. Consumer and merchants across Europe must therefore adhere to the terms, prices, and data practices set by a few, mostly non-European, private companies, and have limited scope for negotiating or switching. Between 2018 and 2022, in the EU, the average net merchant service charges almost doubled, despite the regulatory effort to contain them. The EU interchange fee regulation, adopted in 2015, capped consumer interchange fees at 0.2% for debit card and to 0.3% for credit cards. But international card schemes have responded by expanding fees categories that fall outside the regulation: scheme fees, processing fees, compliance penalties, effectively eroding the intended benefits of the cap. And the burden falls disproportionately on small merchants, who face fees 3 to 4 times higher than those paid by larger counterparts. This eventually pushes up price for consumer and reduces their purchasing power. Moreover, schemes are still adjusting rules and costs unilaterally. In recent years, for instance, international card schemes start charging merchants additional costs for transactions that do not use the scheme tokens. In May 2025, a coalition of major European retailers wrote to 3 European commissioners warning that international schemes had made their fee system so complex and opaque that merchants, quote, cannot understand, let alone challenge what they are paying and why, end of quote. As more transactions move online, Europe is becoming increasingly dependent on non-European payment infrastructure. Public money, the money of the people issued by their central bank, is now only available in physical form, cash. But cash cannot be used when you pay digitally, such as in e-commerce, which now accounts for more than 1/3 of retail sale by value. Cash use has been declining rapidly from 68% of day-to-day transactions in the euro area between 2019 to 40% in 2025, and from 40 to 24% in value terms over the same period. This shift has been more pronounced in the Baltic states, which are among the most digitalized economies in the euro area. The digital euro is the Eurosystem response to this structural gap. It is a digital form of cash that will be legal tender. In other words, you can use it whenever digital payments are accepted across the euro area. And as it will be available both online and offline, it can be used even when there is no network connection. The benefits of the digital euro can most clearly be seen against the three-dimensional vulnerability I just described. First, the digital euro will reduce Europe's excessive dependence on non-European providers. It will ensure that Europeans can pay with their money, the sovereign money issued by their central bank, in the digital economy, just as they can with cash in the physical economy. By providing a fully European infrastructure governed by European rules, the digital euro can help underpin Europe's economic security. To achieve this, the Eurosystem is working solely with internal providers, the Euro Area National Central Bank, and with external providers that are registered in the EU and are controlled by or owned by EU companies. The digital euro will thus ensure Europe's ability to process its own citizen transaction without depending on infrastructure governed elsewhere. It will also deliver on Europeans' high privacy expectations. The Eurosystem will not be able to identify users, while offline payments will benefit from cash-like privacy levels with transaction details known only to the payer and the payee. Second, the digital euro is designed for continuity and will prevent disruptions. Its infrastructure will be distributed across at least 3 geographical regions, each with multiple servers. Moreover, should their payment service provider experience an outage, users would still be able to access their money and make payments through other providers because their digital euro funds would be held securely on the Eurosystem balance sheet. And the digital euro app would allow users to access and spend their money without interruption. Finally, the offline functionality will ensure that the digital euro can be used even without an internet connection, a phone signal, or access to a functioning ATM. This resilience feature owes much to contribution from national central bank and treasuries of the Baltic states, which are among the most advanced nations in Europe in terms of expertise in cyber defense and operational resilience. And in relation to the third vulnerability, the digital euro will mitigate the downsides of fragmentation and excessive concentration of market power. The Eurosystem will not charge scheme or processing fees for the digital euro transaction, which will mean reduced costs for merchant and payment service providers. Moreover, the digital euro can create the condition for European payments companies to compete at scale, thereby enabling them to contest the dominance of international players. Its open standards and unparalleled acceptance network will provide a common foundation that makes it easier for European payment solutions to scale up and offer innovative services at the European level. For example, the digital euro could be co-badged on European domestic card schemes and integrated in European digital wallets, allowing consumers to pay with this solution throughout the euro area without having to rely on partnership with non-European payment solutions. By providing a common infrastructure that the private sector can build on, the digital euro will be a catalyst for innovation and further strengthen our strategic autonomy. This is another example of how the digital euro will foster a genuine partnership between public and private sector. The digital euro addresses the retail payments gap, which is where Europe dependencies have the most tangible impact on citizens. But the need to preserve or increase our resilience and autonomy also extend to other parts of the payment sector, such as wholesale, business to business, and cross-border transactions. In view of this, the Eurosystem yesterday published its comprehensive payment strategy, a comprehensive vision for the future of European payments landscape. One key part of this vision is the settlement of wholesale transactions. Most large value wholesale transactions are currently settled in central bank money, but tokenization and distributed ledger technologies are opening up new possibilities for how financial instruments are issued and traded. We need to provide central bank money in tokenized form to reduce the risk of developing new dependencies. For example, we should avoid the emergence of a fragmented landscape in which tokenized assets could not be transferred across network, or in which non-European assets would be needed to settle DLT-based wholesale transactions. From September, we will offer tokenized central bank money as part of our Pontes project. This will provide a safe asset and trust common anchor that tokenized market can use to develop at the speed and the scale that Europe needs. Without that anchor, innovative private solution will not be able to scale with confidence, leaving market to depend on settlement assets that present liquidity and credit risk, many of which may be issued in foreign currencies or on non-European platform. Meanwhile, through our APIA project, we aim to develop a blueprint for an integrated, innovative, and resilient European tokenized financial ecosystem in close cooperation with all relevant public and private sector stakeholders. We recently published a roadmap for the project outlining the key policy objectives and the areas where further technical work is needed. Private settlement assets will play a key role in this ecosystem, whether in the form of tokenized deposit or euro-denominated stablecoins issued in Europe, just as commercial bank money does in traditional finance. But with central bank money acting as an anchor of stability, fragmentation is less likely. Tokenized central bank money can provide the settlement bridge that makes assets convertible to one another, enabling, for instance, tokenized deposit to be transferred between banks or stablecoins to be settled in fiat currency directly on-chain. Let me finish by coming full circle. When Latvia adopted the euro in 2014, It was an act of conviction grounded in the belief that shared institution and a shared currency can make small countries stronger and more, not less, independent. The Baltic states then moved faster than most of Europe to embrace the digital economy that the benefits of which are evident in Riga's thriving fintech sector. But the speed also creates a tension that now confronts the whole Europe, namely that an advanced digital economy running largely on infrastructure designed and governed outside Europe exposes us to strategic dependencies. The digital euro and the comprehensive payment strategy we published yesterday are about resolving that tension. The aim to ensure a thriving digital economy, they aim to ensure a thriving digital economy in Europe built on solid European foundation. The next step in the Digital Euro project are for the EU legislator to complete the legislative process and for us in the Eurosystem to prepare the pilot and get ready for issuance from a technical standpoint. More broadly, our task is to ensure that the euro continues to work in all its form across the entire European economy and on European terms. In an increasingly fragmented world, the integrity and independence of Europe's payment infrastructure is a matter of monetary sovereignty. For the Eurosystem, maintaining that sovereignty is a core responsibility. But the time to act is now. Thank you for listening.
Thank you, Piero. A couple of things to kind of lead from your speech, and then please, guys, start raising your hands. You'll have a chance to ask questions, okay? And the mic, please, move around the room. I'm going to give you mine just in a second. As for the conclusion, let me kind of stress a couple of things. The first one, what we've seen that fees have risen. We've seen that opaqueness of how these fees are set has risen. We've seen that this creates risks for our sovereignty. And very clearly, if we want to become a geopolitical power that can set the agenda, then we need to act. And what Piero very clearly said, that euro area, the ECB and the European central banks, of course, are acting. We are moving ahead with this, and we think that that is a thing of high importance, and there is no time to be wasted on this. As for the digital euro, I think one thing needs to be very clearly put at rest. Digital euro is not meant to substitute cash. It will supplement and complement cash. Okay, so both elements will work alongside each other. Okay, so this is to go along with the development of technologies, and of course digital euro will ensure, as Piero very clearly stressed, will ensure privacy. Okay, so there is no worry about that. The big brother is not around. Okay, so let's do it here rather than delegate to somebody else where the big brother could really be engaged. Point two, digital euro as a catalyst for the financial innovation by the private sector. So we are not trying to squeeze out the private sector. We're trying to create environment that allows for the private sector to build on and become really globally competitive. Okay? So this is a public good that we provide rather than we take away something. And I think the last point that I want to stress is we've been talking a lot about digital euro, retail digital euro, which will, you know, come to your cinemas nearby in 2029, 2030. Okay, but there is a very, you know, interesting movie coming to your cinema, which is Wholesale CBDC. And that is going to be tested already in September this year, which opens up massive possibilities to build smart contracts and whatever else. So this is the future of finance. Okay? So I think these are all the areas that we, of course, can talk about, and your questions and feedback is very much welcome. I have a few questions that I want to ask as well, but I'll give chance to you, and I'll hope I'll have time to ask my questions at the end. Okay.
Thank you. Dear Mr. Cipollone, before you're considering implementing a digital euro, I hope you can answer my simple question. What is the total cost for implementing a digital euro?
Should we take some...
It's not that we are evading the question, you know. Any other questions? Yes. And then up there as well. We'll take 3 questions.
Hi, sir. First of all, thank you for coming. It's a great honor for us to be able to listen to you. My question is a very basic, simple one. In your European Parliament testimony, you said that the digital euro will never be programmable money, and there will be no restrictions of when, how, and where it can be used. However, in Ljubljana, in one of your lectures, and I promise you I'm not stalking you, you seem to be a proponent of conditional payments. You said that the digital euro will help in automatic reimbursements and so on and so forth. My question is, who determines the line between programmable money and conditional payments? And how are we to know? Are there any safeguards in place? Or is it just tomorrow the ECB can say we're going to ban payments to crypto exchanges, for example, or to online gaming sites? Is there something in place for that, or is it just a trust me bro kind of thing?
Thank you. And then in the back row.
Hi. So I would say my question is a bit of a simpler one. So I'm wondering if the end goal is to switch fully to digital euro and stop using those international digital services. And if you have like a plan in mind, what would be kind of the time frame where you're planning to switch? Yeah, and that'll be all.
Thank you.
Okay. Let me start from the last one. We are a central bank, and our mandate is to provide means of payment to citizens and to banks and intermediaries. That's our business, and that's what we do. We have been doing that for decades. Unfortunately, from retail payments, the means of payment that we provide, which is cash, is not able to cover all the needs of the citizen. So we need to cover this space that is not covered now, otherwise we would be discriminating against central bank money. But we are on the supply side. We don't decide how people should pay. In fact, Mārtiņš was saying, for us, cash will be there because this is another opportunity for people to pay. We are not in the business of deciding on telling people how they should pay. It's our responsibility to offer a resilient, efficient, and competitive payment infrastructure and market, and central bank money is part of this offering, and that's what we are doing. We don't have any intention to kick anybody out of the market. We want a competitive, resilient, open market where companies, whoever they are, can compete and provide the services to the citizen with better quality and lower prices. There is a fundamental difference between programmable money and conditional payments. Conditional payments means means that our payments will go through if certain situation occurs. This is already here. When you say to your bank, please pay at the end of the month this amount to this person, this is a conditional payment. What we are doing is enlarging the scope of this kind of payments. So we are building the machine so that through a mechanism that is called reservation of fund, such that whenever the condition of certain payments are met, the payment goes through. And this is something that is established between you and your bank. The bank, your provider, is the one that will be building the condition around the payment. What is the difference? That once the payment is released, that money is as good as new. Programmable payments means completely a different thing. Means that payments can be, that token, that amount of money can be directly only for the scope for which has been issued. So it's a kind of voucher. You can use this money only to pay, to buy whatever. This is not what we are issuing. And what is the, you say, what's the safeguard that we have? First of all, we are not building a machine in order to be able to do that. But it would be a huge contradiction for our mandate. We are in the business of providing singleness of money. Singleness of money means that €1 is always €1. If this is programmable, this €1 that is programmable cannot change at pair with another euro because the scope of that euro it's limited. So we would be contradicting what we do for job and we have been doing for so many years. The first question is very simple. The cost has been, we have been published, the amount are public. So to build the machine, the settlement, the engine, the connection, the cost is going to be 1.3 billion for the euro area. Billion, 1.3 billion. This is a number that we published. And then there is the cost for the implementation by the banking sector that have been estimated between 4 and 5.8 billion for 4 years for the overall euro system, for the euro area, for the whole euro area. This might look like a big cost, but this is about 3% of the cost that the bank system incur every year for the IT investment every year in the euro area. So essentially the cost is from 1 to 1.4 billion a year for 4 years for the European, for the banking sector, and for us 1.3 billion, which by the way will be recovered by the seigniorage of the associated to the digital euro.
Let me give you just another comparison. Of course, billions sound a lot. Okay, these are big numbers, but if you take this 1.3 billion and divide by the number of people who can benefit from increased, well, they can regain sovereignty. Okay, then it's about €3 per person, which is kind of a cup of good coffee, okay, per year. Does not sound that much to me if you can create a sovereign financial system, okay, that reduces those kind of risks. But of course, we are very cost aware, and we are always paying lots of attention to how much this, at the end of the day, costs also to the sector. Okay.
By the way, if we are talking about if your interest is in the public purse, then there is another calculation that you should make, which is the following: if cash is going to decline as it is, this means that the seigniorage of the central bank is going to decline, which means that the treasury is getting less money. So if the digital euro would allow some central bank money to stay in the economy, we would recover these revenues and ship it to the treasury. So in addition to provide people the freedom to pay with their central bank money, this will also be good for the treasuries.
Okay, before others raise hand, okay, I'll ask a question of mine. I hope I'll squeeze in. You mentioned stablecoins, but I think just in passing, how does it all square together? Digital euro stablecoins. Are stablecoins a threat or an opportunity? Then question number 2, and who wants to have the question number 3 in this round? Please raise your hand. Okay.
Maybe a couple of questions built in. One, how does this, if you're from the ECB perspective, encourage people like Poland to come into the Eurozone going forward? And if they're not there, what's the impact on them? Secondly, where is the digital currency already issued? I'm aware that the Central Bank of Kazakhstan has already issued some digital tenge on a trial basis over the last couple of years, but where has it happened so far?
Yes. Can you hear me? Yes, you can. My question is maybe slightly related to what you commented earlier. Your central bank mandate is about ensuring, let's say, good payment infrastructure for the European citizens. And what I want to understand is, does the digital euro project have a more global ambition? And the context to that is, we see that there's a lot of commentary in the market that the US is pushing forward privately issued stablecoins as a way of basically cementing the global hegemony of the US dollar for the 21st century. The biggest strategic vulnerability to that, I guess, is the unsustainability of the US fiscal situation. The question, does this present an opportunity for the digital euro to become a more globally dominant currency?
Okay. Let me start from Mārtiņ's question about stablecoins, whether they are a threat or an opportunity. Let me put it this way. They are an opportunity as long as they try to solve some failure or they improve the services on some space. Today, the most interesting space, the most probable use case on which stable coins might enter is cross-border payments. And you know why. Cross-border payments are expensive, are slow, are non-transparent. It takes, long time to transfer. I don't remember exactly the figure, but just I do remember one. To transfer, the average cost around the world to transfer $200 is 6.8%. That's the cost. You understand that whoever can enter this space and provide better services is welcome. So if the stable coins are going to solve this, welcome. At the same time, we need to understand what are the implications of the stable coins. I'm not abstracting from the pathology of the system, meaning the possibility to depeg and things like that. We need to understand that there is a fundamental shift that stable coins will bring in the balance sheet of the banks. If I am a client of a bank, today I have my deposit at the bank. Tomorrow, if I buy the stable coin with that deposit, that amount would leave the bank. It will come back to the bank, but will come back at the bank in a different form. Will come back to the bank as a wholesale deposit, which is a completely different animal. It's more volatile, it's more costly, and So basically, you change the structure of the liability of the banks away from retail deposit, more wholesale deposit. Moreover, since not all banks will receive the reserve fund from the stable coins, you might have concentration risk. So what is possible that is going to happen is that deposit will be sucked by small banks and concentrated on more important banks. So this is the transformation. So the question we want us to ask to ourselves is, we should ask ourselves is there any possibility that we use the same logic of stable coins to provide for the same services while not changing, preventing this change I was referring at? And one possible solution are tokenized deposit. Tokenized deposit might do the same job as stable coins because essentially they are a file that you can ship around the world instantly and 24/7, but they stay within the remit that we have today. They are protected, and they have as a reserve the balance sheet of the bank. So that's my answer. Threat and opportunities at the same time. Case by case and use case by use case, we should look at which is the most efficient solution for that.
And just to add a bit of that, of course, this narrow banking issue also is important for the European economy because banks are the major source of financing.
Yeah,
Okay?
especially small.
If we withdraw deposit base from banks, that might at least make the financing more expensive or in some cases even undermine it. Okay? So there are those kinds of risks as well.
So are we inviting other jurisdiction to join? I mean, that's a matter of sovereignty of each country. We are open, as you know. There is a process. Whenever the country are ready to join, they will. There is a process in place. What we are doing for the digital euro is offer a possibility of other jurisdiction to allow the citizen to use the digital euro. And there are two categories. One are the countries that are in the EU and countries that are outside the EU. For countries that are inside the EU, will be enough to have an agreement between the central bank, the two central banks, the Eurosystem central bank and that jurisdiction bank, that would allow to allow the citizen to use it. For countries that are outside the EU, is needed the agreement between the central banks, but also by the member states, the states. We are doing that because we want to respect the sovereignty of the countries. We are not pushing the digital euro as a, kind of dominance currency. Currency substitution is a serious issue, and we speak about our own monetary sovereignty, so we should respect other people's monetary sovereignty. And this goes a little bit in the direction of the third question. We are doing this for us, first of all. We need to solve our own problem. But this is a more general attitude in Europe, I would say. We should be doing things that are good for us, first of all, without thinking too much about reacting to somebody else. We have so many things to do, deepening the single market, increase the autonomy of our payments system. This is a way to become more resilient and to make our economy stronger. Then if other people believe that this is a good deal to issue stuff, even for the wholesale, right? Then if people think that it's a good idea to come in Europe to issue bonds because the market is more liquid or you can trade on a DLT, that's welcome, but that's not the fundamental reason why we are doing this.
Thank you. Just one addition to what Piero already mentioned about countries willing to potentially join the euro area. Being in this room, which is part of Stockholm School of Economics in Riga. Swedes have just issued a paper on whether they should join the euro area, and the answer by and large is yes. Okay, so the political process with respect to that might start moving again. So yes, the better is our economy, the more advanced our financial markets, the allure of becoming part of the euro area will increase. And we see that also in terms of using, for instance, our payment systems, our TIPS instant payment system, which is increasingly drawing in other countries which are not part of the euro area at the moment, and some perhaps will never be. Okay, but use the efficiency of the payment system is a very big advantage also to establish a bigger role for the euro, that if the economy also does what is necessary, all the structural reforms would be beneficial. Okay, guys, the last round of questions. There was one question over there earlier as well. Here. So could we have the mic also over there? Yeah.
Thank you for an opportunity to listen to this presentation. I would like to ask about the merchants, because you have covered the costs for the industry and also for the banks, but I wonder about small merchants and medium-sized merchants, and also about offline transactions and potential fraud, and who will bear the costs for preventing potential double spending and eliminating these fraud cases. Thank you.
Thank you very much for the presentation and your clarifications. I was wondering, sovereignty is one of the key aspects or goals of the digital euro. I was just thinking that will require as well technical infrastructure, and in those terms, software, hardware, cloud. In that regard, we're also very, very dependent. So has the ECB then thought or has figured out how we will ensure sovereignty also on that level? That's one question. Maybe I can also quickly, another question. You mentioned digital euro app, and there is also another tool under development, currently under implementation in member states, which is the EID wallet, also aimed to contain or to be used for containing digital euros in it. As the ECB works on technical infrastructure, I would assume that you also are considering how those will be integrated or interoperable. But just knowing that there are several of these elements already in the making, and it's becoming a bit difficult maybe for our citizens to understand how that all works together. Will it be on member states then the responsibility to educate, or the ECB will do that job? Thank you.
This is okay.
The last question in this round, please.
You have mentioned already stablecoins and digital euro. It sounds like actually tokenizing cash. If so, is it going to fall under MiCA regulation somehow? Or is it for banks and EMIs only? Will MiCA licensees participate again in the implementation of it?
Thank you. Okay, let me start from this third question. No, the digital euro will have its own regulation, which is in the making in the parliament, and will be on the trialogue, hopefully in the summer. So the digital euro will have its own regulation, which is not under MiCA. So you asked many questions about sovereignty and a series of additional questions. So we need to understand exactly what we mean by sovereignty. So the digital euro, the whole construction of the digital euro, so the providers for the ECB will be European entities owned by Europeans. So the first layer will be European. Then we have rules for subcontracting, meaning that you cannot be dependent entirely on other people. But then you could say, well, but at the end of the day, people are using Microsoft, so you may be, in any case, dependent on that. That's a different story, though, because you can the longer is the supply chain and the more diversified are the supplier, the less dependent you are. But we need to start from somewhere, right? We don't have an entire filiere that is completely owned by the Europeans, and I am not sure that that's what you want completely. At the commodity level, you want competition so that people can, I mean, for the server, you would like to have as many providers of servers because you want to be able to choose. What is important is that you are under control of the architecture, the meaning, the rule of the game. That's what is very important on the sovereignty. On the integration with other wallets, yes, this is a fundamental, one of the legislation, if I understand it correctly, you are referring to other wallet, the providing means of payments, right? If I understand correctly. So, no, I mean, definitely, the integration, the most simple way the digital euro can be integrated in the current system is the following. Today, we do not have any solution that caters for all use cases for all euro area countries. There is no solution in Europe. So the question is, if any of those private service provider wants to give a full range of services to their clients, meaning the ability to pay everywhere in Europe, they need to do something with the international card scheme. They need to co-badge or do something together, which is costly. If they co-badge with the digital euro, they could reduce the cost because the digital euro will not charge scheme fee to this. So they could provide the same services to the citizen without incurring the cost associated with co-badging with the international card scheme. For merchants, now, as I said, whatever it costs to provide our payments, part of this cost today is for scheme fee and the cost of infrastructure interoperability. This cost will not be charged to the system because it will be borne by the Eurosystem. So the question is, how do you distribute among the actors these savings? And the actors are the person that pays, and today they do not pay and they will not pay anything tomorrow. Then you have the merchants, and then you have the banks. So the question is, how do you distribute the saving among these two actors? This is not for us to decide, this is for the co-legislator. But in any case, the co-legislator are proposing to put a cap on the merchant charges fees. And these caps will benefit especially small merchants that pay 3 to 4 times the cost that large merchants are paying. By putting a cap, which is a sort of average, we need to understand exactly how will be calculated, but by putting a cap, this cap will benefit especially the small merchants, which are the ones that have less negotiating power and therefore pay higher fee. As for the fraud, we will be doing we are providing a service to detect fraud for the whole system.
I've been signaled already a couple of times that we've run out of time, but I want to squeeze in one more question. So unfortunately, those who need to switch off, sorry for that, come back later, take a look at the record of the conversation. But we know what we are doing in Europe. Okay? We have agenda for wholesale and retail CBDC. But how does it all tie together with others? Swedes were the early movers in terms of the CBDC, retail CBDC, and then they kind of put it on ice. Okay, now they are in a waiting mode. We take a look at the U.S. U.S. said, no way. There's going to be no CBDC. There's going to be stablecoin. Then the BIS, Bank for International Settlements, did a fantastic piece in 2023 saying, the future architecture of the global financial markets would be based on the CBDC, tokenized deposits. Now it seems like everybody is going his or her own way. You know, it's like a kind of ball of spaghettis. You know, you don't really know where it ends up. What is your view on the final destination for the financial markets? How is this going to be, you know, resolving itself, and what's the destination the global financial markets are moving to?
Yeah. So let me say something on the wholesale part, which is maybe more relevant. Yeah, there was this vision by the BIS that one day we would be all sitting on one ledger, one big DLT where central bank money, commercial bank money, tokenized asset will live in and freely moving back and forth. There are two dimensions to that, which, I mean, that was an initial intuition by Carsten, which is still valid in the logic of it. Because definitely this solution would allow you to trade 24/7, instantly, no lead time. You can put smart contract on that, so you can automatize many processes that today are done manually. You don't need to reconcile, so there are large benefits to that. But you have two big problems to address. One is governance. In such a fragmented world, how do we put together member states, private sector? Would be a huge endeavor. Second, to me, there is a fundamental issue in terms of innovation. Imagine that we converge all on the same ledger, which today is at the frontier of the technological innovation. But then tomorrow, a young, brilliant student from the Stockholm school in Riga invents a new way. And a DLT 3.0, which is much faster, more efficient, consume 1/3 of the energy, whatever. How do you make sure that people will jump on this new technology if you have such a vested interest, so much interest in the whole technology? This, I mean, what kind of incentive do you need? So we need to keep some kind of competition at the infrastructure level. And this is our own thinking for Appia, by the way. So, but this is not, I mean, it's not that the discussion has gone. There is an ongoing project which is called Agora, which is, for the moment, focused more on how do you do cross-border payments using wholesale money, both central bank money and the commercial bank money. This project is going on. Is trying to address this problem by, adjusting here and there, but the project is live. The Eurosystem is participating on that project, and soon we will enter in the phase of running real experiment, making real transfer of money. Where are we going in the long run? I don't know. But what we need to keep open is the discussion with all other jurisdiction. Make sure that we agree at least on standards, so that you make the system compatible. Maybe one day we will reopen the pipe. But and the international cooperation need to be strengthened in order to avoid further fragmentation.
Thank you. If any of you thought that central banking is a boring business, okay, you've been wrong. There's so many things going on, so many innovations to build on by the private sector. So do follow us. There's lots of opportunities, and use them. Okay, make it profitable to build on the opportunities that we provide. So this is a very vibrant area for financial markets, and we at the ECB and Euro area will work hard to create opportunities for you. So use them and talk to us. If you see opportunities that are not used yet, do talk to us. Let's build a cooperation that builds stronger economic growth. Okay, so thank you very much. Thanks, Piero.